Washington, District of Columbia, July 21st, 2010. Flashbulbs illuminate the Ronald Reagan building as politicians sign the Dodd-Frank Act, applauding the supposed end of systemic financial risk. But 200 miles north, inside the mahogany backrooms of Midtown Manhattan law firms, the actual financial engineers are not defeated. They are ecstatic. They are dissecting the new Volcker rule line by line. The government is forcing traditional banks out of middle-market proprietary lending. A massive regulatory vacuum is opening, right as the global economy desperately needs capital. And simultaneously, an impossible math equation is being born. Over the next decade, the shadow banking sector will achieve an economic miracle. They will report record-breaking cash distributions to public pension funds, and they will maintain a 0% default rate, all while the macro interest rate climbs to 5.5%, and the underlying corporate borrowers bleed negative cash flow. This is the $1.7 trillion private credit paradox. It is the story of how Wall Street manufactured paper profits out of deferred defaults. The shift happens in quiet conversations over expensive dinners. The traditional bank executive leans across the table to the emerging private credit manager. The banker says, "We're in regulatory handcuffs. Basel III capital requirements mean we cannot hold these risky middle-market loans on our balance sheet anymore. The regulators are breathing down our necks." The shadow lender smiles, swirls his wine, and replies, "Then give them to us. We will step into the void you left behind. We will charge double the interest rate spread, and, because we are not a bank, the federal regulators will not even have the jurisdiction to ask for our balance sheets." The private credit manager realizes he has a monopoly on capital. But he needs a massive source of funding to originate these loans. He needs an institution with deep pockets and a desperate mathematical need for yield. He finds the perfect mark: the American Public Pension Fund, sitting on a $1.4 trillion underfunding gap, desperate to hit a guaranteed 7.2% annual return to keep state governments afloat. If you want to understand how the global economy works, hit the subscribe button to join the few who track the real flow of capital. The mechanism that funds this new shadow banking empire relies on an aggressive form of regulatory arbitrage. In traditional finance, if a bank makes a bad loan, public market regulators and daily trading exchanges price that failure immediately. The stock price tanks. But private credit operates in the dark. A state pension fund writes a $100 million check to a special purpose vehicle, a limited liability company set up in Delaware by a shadow banking manager. That vehicle takes the cash and loans it to a mid-sized private equity-backed company. Because the loan is never traded on a public exchange, its value is whatever the manager says it is. The pension funds pour in. By 2020, they have allocated up to 40% of their entire portfolios into these illiquid private assets. They are trading daily transparency for the promise of a steady, guaranteed yield that does not bounce around with the stock market. The setup is flawless, as long as the underlying borrowers actually pay their interest. And for a brief window, fueled by a 0% interest rate environment, they do. The private credit managers collect their massive fees, the pension fund directors report steady gains to the state legislature, and the retirees sleep soundly. The machine hums. But the foundational premise of this entire $1.7 trillion market rests on a dangerous assumption. It assumes that the credit agreements protecting the pension fund's money are ironclad. It assumes that if a borrower stops paying, the shadow lender can simply seize the collateral and make the public teachers and firefighters whole. That assumption is about to be tested in the sweltering heat of a European conference centre, where the fine print is quietly being rewritten to strip away every single financial safeguard. The golden age of shadow lending is about to mutate into the most reckless debt binge in modern financial history, leaving the actual investors entirely exposed to the downside. Berlin, Germany, November 9th, 2021. The peak of the zero interest rate environment. The super return private equity conference halls are sweltering, packed shoulder to shoulder with pension fund chief investment officers desperate for yield. Champagne is poured continuously at vendor booths, while asset managers aggressively market their newest product, unitranche debt. It is a blended, highly leveraged loan that completely lacks traditional maintenance covenants. In previous decades, a lender would demand strict financial checkpoints. Now, those safeguards are gone. The pension managers are signing commitment letters for 90% loan-to-value debt without demanding a single financial safeguard. They are terrified of missing out on the advertised 8% yields. The atmosphere is euphoric, blinded by a decade of free money. No one asks what happens if the macro environment shifts, because no one believes it ever will. The capital commitments flow into the billions, locked up for 7 to 10 years, secured by nothing more than a gentleman's agreement and a slick pitch deck. The complete erosion of lending standards is captured perfectly on the trading floor of a private credit syndication desk. The junior associate looks at the loan document and asks the senior partner, "Wait, we stripped every financial covenant out of the credit agreement? There is no limit on how much extra debt they can take on, and no requirement to maintain cash reserves?" The senior partner does not even look up from his monitors. He replies, "I know, and they still oversubscribed the book by $400 million. The limited partners literally do not care what the documents say, as long as the distribution check clears on Friday. This dialogue represents the birth of the Covenant-Lite Binge. The institutional investors, the ones guarding the retirement funds of millions of everyday workers, willingly surrendered their legal ability to monitor the financial health of the companies they were lending to. They handed a blank check to private equity sponsors, trading away structural security for a slightly higher interest rate spread on paper. To justify these massive, unsecured loans, the private equity sponsors engineer a structural distortion called the denominator fraud, relying on EBITDA add-backs. In traditional finance, a safe corporate loan is measured by the debt-to-earnings ratio. If a company has $50 million in debt and $10 million in actual cash earnings, the leverage ratio is 5 times. That is generally considered safe. But the shadow lenders allow the borrower to manipulate the earnings side of the equation. The private equity sponsor tells the lender, "If we fire 20% of the staff next year, our earnings will technically be $20 million higher. So let us borrow against that imaginary future money today." They add back restructuring costs, projected synergies, and hypothetical market expansions. A company with a true $10 million in earnings suddenly reports $40 million on paper. A $200 million loan looks like a safe 5 times leverage ratio to the pension fund, when in reality it is a catastrophic 20 times leverage ratio against actual current cash flow. This accounting fantasy works flawlessly while interest rates sit near zero. The underlying companies can barely afford to service the debt, but the cheap cost of capital keeps the facade intact. Then, the macroeconomic tectonic plates shift. The Federal Reserve embarks on the most aggressive rate hiking cycle in modern history. The cost of borrowing rockets to 5.5%. Suddenly, that middle market company carrying a $200 million loan finds its interest expense doubling overnight. The company is now bleeding negative free cash flow. They do not have the cash to pay the shadow lender, which means the shadow lender does not have the cash to pay the pension fund. The mathematical reality of the denominator fraud is colliding with the physical reality of a drained bank account. The private credit market is staring down an apocalyptic wave of defaults. But instead of admitting failure, the shadow lenders deploy an accounting trick so audacious it redefines the concept of profit entirely. New York City, Midtown Manhattan, a sterile, glass-walled executive boardroom inside a major private credit management firm. The air conditioning hums against the quiet panic in the room. The firm's flagship middle-market portfolio company has officially failed to generate enough cash to pay its 12% interest expense. It owes $24 million in cash interest this quarter, but its bank accounts are empty. The junior accountant stares at the general ledger. If they report the missed payment, the loan goes into technical default. The asset will be marked down, the firm's performance fees will instantly evaporate, and the state pension fund will panic. The accounting team is trapped. A missed payment in the public bond market would trigger an immediate restructuring and headlines across the financial press. But in the private credit market, there are no public exchanges and there are no daily price disclosures. The executives realize they do not have to accept the loss. They just have to change the definition of the payment. The private credit manager picks up the phone and calls the portfolio company executive. The borrower says, "We are tapped out. We cannot make the $24 million interest payment. We need to restructure." The credit manager remains entirely calm. He says, "Do not declare a default. We are just going to flip the switch. We are going to execute a payment in kind amendment. Instead of paying us $24 million in cash, we are just going to add $24 million to your total loan balance. You now owe us $224 million. The borrower is confused but relieved. The credit manager then calls his internal auditor. He says, "We just increased the principal balance of the loan. I need you to record that $24 million debt increase as current interest revenue on our income statement." The auditor reviews the GAAP accounting guidelines and replies, "Since the contract allows it, we can recognize the phantom payment as real revenue today." This legally sanctioned accounting fiction is called a payment in kind, or PIK toggle. To understand the sheer absurdity of this mechanism, imagine your house is freezing because the furnace is entirely broken. You have two choices. You can pay the massive cost to fix the furnace and acknowledge the structural problem, or you can take a black Sharpie and write 72 degrees over the thermometer glass. The PIK toggle is the Sharpie. Under accrual accounting rules, the private credit fund records the unpaid interest as current revenue, even though they received absolutely zero cash. Furthermore, the fund marks the asset at 100 cents on the dollar, using Level 3 valuation rules. Since there is no public market to dispute the price, the lender uses their own proprietary mathematical models to justify the pristine valuation. They are charging public pension funds billions of dollars in management fees to paint numbers on the thermometer glass, while the financial pipes of the underlying companies freeze and burst. The shadow lender has successfully masked the default. They report a pristine asset value and a record-setting quarterly profit to their institutional limited partners. But a glaring, systemic problem remains. The shadow lender's contract entitles them to a 20% performance fee on that phantom $24 million revenue. And the pension fund is expecting their quarterly cash distribution check in the mail to pay their retirees. But the shadow lender's bank account is empty. You cannot pay a retired teacher's grocery bill with an accounting entry. The private credit fund desperately needs hard currency to maintain the illusion. They need cash to pay out the distributions that keep the pension funds pouring new capital into the system. To bridge this massive liquidity gap, the shadow lenders turn to Wall Street investment banks and execute a maneuver so dangerous it threatens to drag the highly regulated traditional banking system right back into the blast radius of the shadow economy. Glendale, California, September 2017. The fluorescent lights buzz inside the executive suite of Direct Lending Investments. CEO Brendan Ross sits completely isolated at his computer terminal. The illusion is fracturing. The underlying small business loans in his $250 million shadow lending portfolio are defaulting en masse. The borrowers are simply walking away. Ross stares at the master database, realizing that if he reports the true, catastrophic default rate to his institutional auditors, the fund will collapse by morning. The institutional money will freeze, and the firm will be liquidated. Panic overrides his fiduciary duty. In the absolute quiet of his office, Ross begins manually altering the payment codes in the digital ledger. He is changing the status of dead loans from defaulted to current. But altering a spreadsheet does not solve the cash shortfall. He needs actual, verifiable money moving through the accounts to fool the audit team before they pull the quarterly performance sample. Ross drafts an urgent internal communication to his primary lending counterparty. He writes, "Can you just send me the underlying data in a format I can edit? I need to smooth the defaults before the audit team pulls the sample." But a spreadsheet edit is not enough to pass a forensic cash audit. Ross gets his counterparty on a secure line and issues a directive. He says, "We are going to execute a round-trip transaction. I am going to wire the fund's own capital out to your shell company. Then, I need you to wire that exact same money right back into our master account. We will record the incoming wire as a borrower payment on the defaulting loans." The counterparty agrees. They are literally using the pension fund's own money to pay the pension fund's interest, creating a closed loop of systemic fraud. They are manufacturing a perfect illusion of health to keep the institutional capital flowing, hiding behind the opacity of private markets. Brendan Ross eventually went to federal prison, but the mechanism of borrowing money to pay fake yields was simply institutionalized and made legal by the broader market. It is called net asset value lending, or NAV lending. Imagine you lose your job and cannot pay your $2,000 monthly mortgage. Instead of foreclosing, the bank simply adds the $2,000 to your total debt, reports to its shareholders that you paid in full, and then takes out a line of credit against your house to pay its executives their year-end bonuses. The house is rotting, but on paper, everyone is wealthy. Private credit funds approach traditional investment banks like Goldman Sachs. The shadow fund pledges their entire portfolio of inflated, non-paying loans as collateral. In exchange, the Wall Street Bank issues a massive 9-figure cash loan to the shadow fund. The fund uses that borrowed bank cash to pay their own performance fees and issue the distribution checks to the pension funds. The pension fund receives a cash check, believing it represents the healthy interest paid by a thriving mid-market company. In reality, the pension fund is being paid with bank leverage secured against a defaulting, uncollectible loan. Currently, an estimated $150 billion to $300 billion in NAV lending operates entirely off-balance sheet, invisible to public regulators. The systemic danger is exponential. Traditional banks are now directly exposed to the toxic waste of the shadow banking sector. The original corporate borrower's debt burden is compounding daily, mathematically guaranteeing an eventual bankruptcy. The entire $1.7 trillion architecture is built on the premise that the private credit funds hold senior secured claims on the borrower's assets. When the inevitable bankruptcy comes, the pension funds believe they will at least recover the hard assets. But they are about to discover that the private equity sponsors have already mapped out a legal trapdoor. A virtual boardroom on a Zoom call, June 8, 2020. The executives of Serta Simmons Bedding and their private equity sponsors at Apollo Global Management are executing a ruthless financial maneuver. Serta is suffocating under a massive pile of debt, unable to service the loans held by various traditional and shadow lenders, including public pension-backed vehicles. The lenders are sitting at their monitors, expecting a standard debt restructuring negotiation. They believe their senior secured status guarantees them the first claim on Serta's manufacturing plants and intellectual property. Instead, they witness a chilling, bloodless execution of a liability management exercise. In a matter of minutes, the private equity sponsor activates a hidden clause buried deep in the Covenant-Lite credit agreements. The original lenders watch in stunned silence as the core assets of the company are legally transferred entirely out of their reach, vaporizing their collateral in real time. A distressed debt analyst jumps on a recorded client call, his voice laced with disbelief. He says to his institutional clients, "They just moved the collateral out the back door while we were knocking on the front." Apollo just shifted Serta's core intellectual property into a brand new unrestricted subsidiary. They took out a massive new loan from a favoured group of hedge funds against those specific assets, and they explicitly subordinated our original debt. The pension fund representative on the line asks, "But what about our senior secured status?" The analyst replies, "It is gone. The loans we sold to the pensions are now backed by absolutely nothing. The senior secured paper just dropped from 90 cents on the dollar to 15 cents in a matter of seconds." This manoeuvre, known as an up-tiering transaction, shatters the foundational promise of private credit. The supposed safety of senior secured debt is exposed as an illusion, rewritten by high-paid lawyers to ensure the original lenders take the catastrophic loss. The ultimate realization of this collateral stripping reaches its apex with the Pluralsight surrender in May 2024. Vista Equity Partners, a premier software private equity firm, realizes their $3.5 billion buyout of the tech company is effectively dead. Rising interest rates have crushed the company's valuation and its ability to generate free cash flow. In previous decades, the equity sponsor would inject more capital to save the company, acting as a protective cushion for the debt holders. Instead, Vista does the unthinkable. They completely write down their multi-billion-dollar investment to zero, and they simply walk away. They drop the keys to a distressed, cash-burning software firm right onto the desks of the private credit lenders, including Ares and BlackRock. The private credit funds suddenly transition from passive, yield-collecting lenders into the unwilling operators of a failing enterprise. The massive equity cushion that they promised the pension funds would protect them is officially gone. The fallout is immediate and brutal. A frustrated limited partner dials into the private credit fund's quarterly earnings call following the massive write-down. The limited partner says, "You told us we were senior secured. You told us Vista Equity would never abandon a multi-billion-dollar equity check. Now you are telling me we own a melting ice cube, and my retirees are taking the haircut?" The private credit manager has no defense. The shadow lenders are now holding the toxic equity of bankrupt companies, entirely incapable of operating them. The facade of risk-free, smoothed returns is disintegrating. But the most terrifying aspect of this slow-motion crash is not that the loans are failing. It is that the gatekeepers of the financial system, the people hired to audit the books and protect the public money, are actively incentivized to look the other way. The final collapse will not be caused by a lack of capital, but by a catastrophic failure of institutional honesty. The capital of a major American state, inside the Legislative Assembly Hall. It is the end of the fiscal quarter. The State Pension Fund Chief Investment Officer stands before a panel of lawmakers. The global bond markets are in turmoil. Public equities have swung wildly, and inflation is ravaging the state budget. Yet, the Chief Investment Officer pulls up a slide deck showing a perfectly smooth, upward-sloping line. He proudly reports to the legislature that their private credit allocation has achieved an uninterrupted 7.2% annualized return. The lawmakers applaud, relieved that they will not have to raise public taxes or cut retiree benefits to cover the state's $1.4 trillion aggregate underfunding gap. But the smooth line on the projector screen is a mathematical fiction. The Chief Investment Officer knows that the underlying companies in the portfolio are executing payment-in-kind amendments and bleeding cash. He is actively choosing to embrace the illusion, because reality would cost him his job. In a private conversation after the hearing, a junior risk analyst confronts the Chief Investment Officer. The analyst says, "Sir, we are holding hundreds of millions of dollars in loans that are surviving purely on bank leverage and phantom interest. If we demand a third-party mark-to-market valuation, we will have to write down 30% of the portfolio. The pension will instantly breach its funding requirements." The Chief Investment Officer packs his briefcase and replies, "Then we do not demand a market valuation. I operate under an impossible legislative mandate. If I acknowledge the true, discounted value of this debt, it triggers a catastrophic underfunding crisis on my watch. Private credit offers us smoothed returns because the loans are not traded on open exchanges. I do not want price discovery. I want stability on paper until I retire. The supposedly victimized pension funds are actually the most cynical participants in the market. They are mathematically incentivized to kick the can down the road. This multi-billion-dollar shell game is legally sanctioned by the ultimate enablers of modern finance, the independent valuation firms and the Big Four auditors. Private credit funds hire valuation agents to provide fair value marks on their illiquid loans. However, these models operate on a strict garbage in, gospel out mandate. The valuation agent relies entirely on the cash flow projections provided by the portfolio company's management. If management projects a miraculous 40% revenue growth next year, the valuation agent plugs it into their discounted cash flow model and blesses the defaulting loan at 100 cents on the dollar. The valuation firms are paid by the private credit funds. Rejecting their assumptions means losing the client. Meanwhile, the Big Four auditors sign off on the financial statements because accounting rules explicitly allow these unobservable inputs. The auditors are simply auditing the math of the proprietary model, completely ignoring the decaying economic reality of the underlying collateral. The $1.7 trillion private credit market is no longer a shadow banking alternative. It is the primary load-bearing pillar of the American public pension system. We are witnessing the exponential rise of payment-in-kind interest and off-balance sheet bank leverage designed solely to obscure mass defaults. The institutional safeguards that supposedly protect senior secured debt have been vaporized by aggressive private equity sponsors. When this leverage loop finally snaps, it will not be the Wall Street billionaires who absorb the impact. The private credit managers have already extracted their cash performance fees. The eventual catastrophic write-downs will fall directly onto the balance sheets of the state pension funds, forcing local governments to either gut the retirements of teachers and firefighters or enact devastating tax hikes to cover the fraud. The fine print has already been rewritten, and the bomb is ticking in plain sight. If you refuse to be caught off guard when the system fractures, subscribe to Capital Curriculum.